Gold prices are running sideways in what seems like a slow trading day for Friday. Here to talk to me about it is John Rutledge. He is the chief investment strategist at Safanad. John, thanks so much for being with us from
Nice
California.
to be here, Joe.
So, John, what are you seeing in the trade?
I think there are pressures pushing in both directions, which is why we see this sideways trade. On the upside, we've got the politics, the global politics. Russia is back. Russia's still a problem, and Putin's actually in Beijing next several days meeting with Chinese leaders. That's not something we like to see. On the downside, you've got deflation news that's made the central banks antsy again. You had a recent report from the Fed about falling farmland prices, so deflation in the farmland. You've got the ECB talking about more stimulus. Even the Germans are agreeing right now. Upside, good Japanese growth quarter. Everyone else seems to be growing sideways. So I think you've got sort of a deflation tug on the price downward on trend with periodic ups and spikes when gold plays the role of insurance for portfolios to offset political risk, which is why you've got no net movement.
Right, and do you expect this to continue for the next few weeks? I mean, when you look at the trading range, even the last 3 days, sure, there's been a down day of nearly 1%, but for the most part, we're seeing those offset.
I think so, Joe, and I think because we're sometime over the next several weeks, we're going to see some more easing moves from central banks. ECB certainly could even be something out of the Fed, but I think that easing move could give gold a lift. But the big story that is the upside for gold is really quite far off into the future yet. It's when the $3 trillion of bank reserves the Fed's created turns into loans and ultimately into inflation. But that story is too far away to help the market today.
So when do you think we'll finally get the story of talking about the Fed unwinding its position?
Yellen was starting to talk last week about it. She said it'll probably be 7 years. People haven't done the math yet. If the number is $3 trillion and it's 7 years, you're talking about the Fed having to do something like $600-700 billion a year, $50 billion a month worth of sales of bonds during a time when they worry about growth. I don't think they're going to do it, which is why ultimately I think the inflation story comes back. But it won't happen until we see the Fed try and fail to reduce their balance sheet back to its normal size.
Well, we'll certainly have to wait and see. Of course, nobody knows if it will fail. Of course, it could be a great success. Again, gold watchers will be on it. But John, as always, thanks so much.
Pleasure.
That's John Rutledge. He's the chief investment strategist at Safanad for TheStreet in New York. Have a nice weekend. I'm Joe Deaux.